They just revised January's job numbers, again, from strong growth down to barely anything. That's a massive revision in 1 month. And that's not even the worst part. The worst part is this is the fourth major revision in recent weeks. The government keeps telling you the job market is strong while quietly admitting they were wrong about nearly 1 million jobs last year. So either they don't know how to count or they're lying to you on purpose. And I think we need to talk about which one it is. Because if you're making financial decisions based on employment data that's systematically wrong by this much, you're not investing. You're gambling with rigged dice. And the house always wins when you don't know the game is rigged. What's up, guys? It's Tom here, and if you've been following this channel since I launched the recession tracking model back in November, you know we've been ahead of this story. We flagged the jobs overcount months before the BLS admitted it. We called out the measurement problems while everyone else was celebrating resilient employment, and the model just moved to 67 out of 100 on the recession risk scale. That's a massive jump in less than a week. To put that in perspective, the model barely moved in the entire previous month. So this kind of acceleration, that's something breaking. We're firmly in pre-recession territory now, and the reason the score is climbing is exactly what we're seeing with these job revisions. The underlying data quality has deteriorated so badly that the statistical models can't tell the difference between measurement error and economic weakness. And when you can't trust the data, the models start screaming warnings because unreliable data in a complex system doesn't just create noise, it creates systemic risk. The data they're feeding you is wrong, and it's not an accident. There's a pattern here that goes way deeper than simple counting errors. So let me break down what's actually happening here, because the story isn't just that they got the numbers wrong. The story is why they keep getting them wrong in the same direction. Every revision goes down, not up. Down. When's the last time you saw a jobs report get revised higher by a lot? I went back and checked. It almost never happens. Out of dozens of monthly reports over recent years, upward revisions are incredibly rare. But here's what's really wild. If the measurement errors were random, if they were just honest mistakes, you'd expect about half to go up and half to go down. Basic statistics. Flip a coin enough times, you get roughly half heads and half tails. Instead, we're getting almost all tails and barely any heads. The probability of that happening by chance is essentially zero. That's not randomness, that's systematic bias. And here's the thing that should terrify you. These aren't small rounding errors. January's revision was massive, December got slashed, November was way off. The entire benchmark revision was off by hundreds of thousands of jobs. To put that in context, that kind of error is like saying the unemployment rate is strong when it's actually showing concerning weakness. That's the difference between strong labor market and we need to cut rates. That's not a measurement problem, that's a credibility crisis. And the fact that they keep doing it suggests it's either incompetence on a massive scale or it's deliberate. Either way, it's dangerous. Now, here's the part nobody talks about, and it's going to blow your mind. The Bureau of Labor Statistics doesn't actually count jobs. They estimate them. They survey a tiny fraction of employers and extrapolate to everyone else. It's like polling a small group and claiming you know what hundreds of millions of Americans think. But it gets worse. The method they use for those extrapolations is called the birth-death model. I'm not making that name up. It's literally called birth-death. They estimate how many new businesses are being born and how many are dying. Then they guess how many jobs those ghost companies are creating. Last year, the birth-death adjustments added over 1 million phantom jobs to the official count, jobs at companies that may or may not exist, hiring workers that may or may not be real. And here's the kicker. They adjust this model based on economic assumptions, not actual data. So if they think the economy should be strong, they assume more business births. If they think it should be weak, they assume more business deaths. It's economic philosophy masquerading as statistical science. Meanwhile, the real data, tax records, payroll processors, continuing unemployment claims, all showed weakness months ago. The actual job count that comes out later showed job growth way lower than the monthly estimates, but that data comes out months late. So they have a choice: wait months for accurate data, or publish estimates in real time that might be massively wrong. They chose speed over accuracy, and the birth-death model gives them exactly what they want. A number that looks scientific but is really just a sophisticated guess. The problem is markets don't wait for revisions. Headlines don't come with asterisks saying this number might be completely wrong. By the time they publish the real data, the narrative is already set. The Fed has already made decisions. Your portfolio has already moved. Mission accomplished. And this matters because the entire financial system runs on these numbers. The Federal Reserve bases interest rate decisions on job reports. Jerome Powell literally cited robust job growth in his recent speeches. But what robust growth? The pathetic private sector jobs ADP reported for February. Let me put that in perspective. Barely any jobs in a month for a labor force of well over 100 million people. That's essentially zero growth. That's barely enough to keep up with population growth, let alone drive economic expansion. And markets move billions of dollars based on these reports. Just recently, the S&P jumped after a jobs report because the headline number beat expectations. But dig into the details, and private payrolls were the weakest in years. Full-time employment actually declined. Average hours worked fell. So you had a market rally based on a headline that was statistically meaningless and a revision that slashed the previous month's number. That's not investing, that's casino capitalism. And the recent trend tells the real story. We're running at stall speed when you smooth out the noise and strip out the birth-death adjustments. That's the labor market creating barely enough jobs to tread water. But the headlines still read, economy adds jobs, because technically something is more than nothing. Even though barely any job creation for this many workers is like adding a cup of water to a lake and calling it a flood. So here's how this plays out. There are really three paths from here, and each one has very different implications for your money. Path 1 is the soft landing scenario. The job market cools gradually, inflation comes down, the Fed cuts rates at just the right pace, and we avoid recession. The employment data stabilizes around decent job creation, enough to absorb new workers, but not so much that it reignites inflation. That's still possible. The yield curve actually uninverted last week, which historically happens before soft landings, but it requires the measurement problems to get fixed, not get worse. Path 2 is the muddle-through economy. Jobs keep getting created, but barely. Growth slows way down but doesn't go negative. Unemployment creeps higher. It's already risen noticeably, and that might not sound like much, but that's hundreds of thousands more people out of work. In this scenario, we avoid technical recession, but feel like we're in one. Corporate earnings flatten, markets go sideways for years, and your retirement account suffers. This is probably where we are right now. Recession, risk elevated, but not inevitable. The model gives this significant probability, but path 3 is the one that keeps me up at night. In this scenario, the job revisions aren't measurement errors, they're early warnings. The labor market is already weakening faster than anyone wants to admit, and the real unemployment rate is higher than the official numbers show. Think about it this way. If they've been overstating job creation by huge amounts for the past year, then the unemployment rate isn't as low as reported. It's probably much higher. And if continuing claims keep rising like they have been, they're up significantly in recent months. We could be looking at much higher unemployment soon. In that scenario, we're not headed for a recession. We're already in one. We just don't know it yet because the data is lagged, biased, and systematically wrong. The model is increasingly pointing toward this scenario. And given what we've seen with these revisions, path 3 is looking more likely every month. The trend is accelerating in the wrong direction. So what does this mean for your money? If you're sitting in index funds thinking you're diversified, you're making a bet that the employment data stabilizes, that the revisions stop being massive, that the job market actually is as strong as the headlines claim. Maybe it is, but the model is telling a different story. Labor market conditions are deteriorating. The quits rate, people voluntarily leaving jobs, has fallen to pre-pandemic levels. That happens when workers lose confidence, when they stop believing better opportunities exist. Job postings are down significantly year over year. LinkedIn's hiring rate has been declining for months straight. These are real-time indicators, not statistical estimates, and they all point in the same direction. If you're job hunting right now, the market is definitely tighter than the official unemployment rate suggests. I'm hearing from viewers that interviews are taking longer, callback rates are lower, and salary negotiations are tougher. That matches what the data should be showing if it were accurate. The pathetic private sector job creation last month, spread across all states, that's basically nothing per state, across all industries, all skill levels, all regions. That's basically noise pretending to be signal. If you're carrying debt, this is absolutely not the time to lever up. Consumer spending has pulled back repeatedly. Credit card delinquencies are rising, and if unemployment starts climbing faster than expected, which it will if the job creation numbers are as overstated as they appear, credit markets tighten up fast. We're already seeing it in auto loans and credit cards. Approval rates are down, interest rates are up, and credit lines are getting cut. That's what happens at the beginning of credit cycles, not the end. And look, I get that this stuff is frustrating. You're trying to make good decisions with bad information. You're being told the economy is fine while your own experience tells you something different. Your grocery bill is higher, your rent went up, Gas prices are volatile, and now I'm telling you the job numbers that are supposed to reassure you're systematically wrong. That cognitive dissonance is real, and it's not your fault. The system is designed to prioritize speed and optimism over accuracy and honesty. But that doesn't mean you have to be a victim of it. Bottom line, the employment numbers are systematically biased upward. Every major revision goes down, not up. The probability of that happening by chance is essentially zero. The model is at 67 because it's seeing through the statistical noise to the underlying economic weakness, and that weakness is accelerating. I remain defensive in my personal portfolio, cash heavy, equity light, duration short, same positioning I've held since November when I launched this model. It's outperformed the S&P significantly with much less volatility, not because I'm smarter than the market, but because I'm not trusting data that's proven unreliable. The forecast is now showing high probability of recession within the next year based on current labor market trends. That's up dramatically in just recent weeks. The model could change if the data improves, but it has to actually improve, not just get reported better. And here's what's really concerning. The model's accuracy has been increasing as the data quality has decreased. That suggests the statistical relationships it's finding are real, even if the official numbers are wrong. The model is essentially reverse engineering the true economic conditions from the pattern of measurement errors. That's both impressive and terrifying. Impressive because it means we can still navigate this environment. Terrifying because it means the official data has become so unreliable that statistical models work better in reverse. If you want to track this stuff in real time instead of waiting for revisions that may never come, I built a full dashboard at recessionistpro.com. Dozens of indicators, recession probability forecast, daily updates, $20 a month, no birth-death models, just real data from real sources. The early access members have been getting these insights weeks before they hit the YouTube channel. They saw the jobs weakness early, the model acceleration recently, and the positioning changes that have protected portfolios while the broader market struggled with false signals. Here's what to watch over the next month. And I'm going on record with specific predictions so you can judge the model's accuracy. First, the next jobs report. If private payrolls come in weak again, and if the previous month gets revised down significantly like we've been seeing, that's confirmation the trend is broken. The model will likely move above 70 if that happens. Second thing, continuing unemployment claims. They're climbing steadily right now. The trend is up significantly from recent lows. If continuing claims break much higher soon, that's not seasonal noise. That's people losing jobs faster than they're finding new ones. That's the early stage of rising unemployment. Third, watch the revisions themselves. If the next report gets revised down by huge amounts when they report the following month, the measurement system isn't just biased. It's completely broken. At that point, you stop trusting the Bureau of Labor Statistics and start building your own indicators. Fourth, the quits rate has been falling for months straight. If it drops much lower, that's the lowest since the pandemic. That would signal workers have lost confidence in the job market completely. Last thing, corporate earnings guidance. If companies start talking about hiring freezes or workforce reductions in their forward guidance, that's the real-time indicator that matters more than any government statistic. The model says we'll know which scenario we're in soon. Either the data stabilizes and recession risk moderates, or the revisions continue